Minneapolis Fed Reserve President Neel Kashkari now saying it's reasonable to predict a December rate cut. Kashkari telling CBS's Face the Nation that the Fed is in a good position to take its time and watch the data. Joining us now to discuss, we have Veronica Willis, Wells Fargo Investment Institute Global Investment Strategist. Veronica, thanks so much for being here. So I know that you still anticipate 2 cuts for this year. Talk to me about what single piece of data you think the Fed would have to see, particularly for Kashkari's call in December, to get moved up a bit to allocate enough time for 2 cuts.
I think it's not going to be one single data point that the Fed is looking at. I think there are going to be multiple data points between now and the end of the year that will give the Fed more confidence to potentially do 2 rate cuts this year instead of the one that they've got penciled in their latest dot plot. There's going to be updates on inflation. If we continue to see inflation moving in the right direction, I think the Fed's going to feel a little bit more confident that they'll be able to cut rates more than once this year. We've got retail sales out this week that I think is going to be really important. If that trend of slowing consumer spending still holds, we're starting to see the economy soften a little bit, but not too much. We start to see inflation come down. We start to see the labor market normalizing, getting a little bit closer to those pre-pandemic levels. I think the Fed will get a little bit more confident about potentially doing 2 rate cuts this year.
Veronica, when we talk about the prospect here of 2 rate cuts, what exactly is that going to look like here for equities? Is that going to be the catalyst, do you think, to really keep this momentum that we certainly have seen in the market alive?
I think, once the Fed starts to cut, the market, I think, has priced that in. So we've seen a lot of exuberance in the market throughout this year as we've come down from, 6 or 7 rate cut expectations at the beginning of this year down to 1 or 2. The market's really still, felt positive about, the prospect of, any cuts at all. And I think that a lot of that's been priced in. So I don't see a lot more exuberance once the Fed starts to actually cut. But there is the potential for the market to still remain strong. We're not expecting a major pullback or anything like that.
Yeah, we were just talking with our markets reporter, Josh Schaefer, about this, and he was mentioning that it's really about the AI trade. I'm curious from your perspective, I know that you trimmed tech to neutral. How do you maintain that perspective given that tech is really driving this market, even perhaps more than the Fed is at this moment?
I think, it's key to remember that tech is a huge sector within, if we're just thinking about the S&P 500. And so even a neutral allocation there is a significant weighting. We're kind of cautioning our investors against getting over their skis in that tech exposure, because we do believe that the AI play is a longer term theme that should be beneficial across multiple sectors. So, thinking in particular of kind of the infrastructure that's needed to maintain AI, and as that is adopted broader across various industries, we think that that could actually be beneficial across more than just the tech sector. And so we're wanting to kind of diversify our exposure there.
And Veronica, I guess more specifically, what should investors be keeping in mind when they are trying to position themselves for that longer term AI play? Is it utilities? Is it energy? Where should they be looking?
Right now, we're favorable on energy, industrials, and materials. And those 3 sectors we think are, positioned really well to benefit from the AI trade. And the valuations are a lot more attractive than thinking about those more stretched valuations in the tech sector.